Good morning and welcome this morning to Introduction to Cryptocurrency. My name is Ben Watson. I'm an education coach and senior manager out here at Charles Schwab. My thanks to our guest this morning, once again, Jim Ferrioli, Director of Cryptocurrency Trading and Research at Charles Schwab. Jim is an integral part of this discussion. He's been with us for the previous 4 iterations of this webcast. He's going to be with us through these next 3 or 4 as well, and hopefully on into the future. So welcome, Jim. I am joined out in the chat by my good friend Connie Hill. She's going to be there to help facilitate the conversation and keep the questions flowing. She's a 20-plus year veteran in the financial markets. She is there to help keep that conversation, whether you are in the live version or the recorded version. Leave us a comment, be a part of this discussion. So we're going to come back to the beginning again, and I'm reminded of Joseph and the Amazing Technicolor Dreamcoat and Donny Osmond. May I return to the beginning, and we're going to talk a little bit again about what is a cryptocurrency today as we get into this discussion. Just as a quick reminder, we'll start to expand on some of the things that we have discussed over the last 4 weeks. And we'll set ourselves up for our next series of webcasts in this discussion of Introduction to Cryptocurrencies. But before we get to that, some very important housekeeping items that we do need to take care of. First of all, this is being recorded. It will be available following this broadcast. Second, remember that everything we talk about, simply for illustrative and educational purposes only, it is not a recommendation or particular solicitation or advice or anything else about a particular account, about a particular security, strategy, or anything else. Remember that we're going to use some technical analysis as we look at charts. Technical analysis is theoretical in nature. It is not a guarantee of future success out there in the real world. Investing involves risk, including the loss of principal. Now, some specific disclosures when it comes to cryptocurrencies. Remember that digital currencies, such as Bitcoin and others, are highly volatile. They're not backed by any central bank or government. Digital currencies lack many of the regulations and consumer protections so far that legal tender currencies and regulated securities have. So due to that high level of risk, investors should view digital currencies as a purely speculative instrument. We'll talk about that as we get into this discussion. So there are additional risks that are at play. Cryptocurrency-related products carry a substantial level of risk. They are not suitable for all investors. Make sure that you understand the characteristics of these products before considering any transactions in the cryptocurrency space, which is why we are doing these webcasts, to make sure that investors have a good handle and a good understanding, at least a solid foundation in an understanding about cryptocurrencies. As we get into this discussion, we're going to be using the Thinkorswim desktop software platform today, specifically the paper money version of that platform. It is not a guarantee of future success out there in the real world. However, it is a great learning environment. It does not do certain things that a live trading account will do, however, namely around the entry of and exit prices that orders might fill at. These are algorithmically derived in the paper money account. They are derived by market forces in a live trading account. So just be aware of those differences as you move your practice from paper trading to live trading. And as we get into this discussion today and start down this road, and as I bring Jim back into this discussion, here's what we're going to talk about in the next 4 weeks. We're going to spend today talking about what is cryptocurrency. Next week, we're going to talk about how does cryptocurrency work. Then we're going to talk a little bit more in depth about how do people get exposure to cryptocurrency. We will touch on that a little bit today. And then we're going to talk about on session 4, what drives cryptocurrency prices, which is a very interesting discussion. But Jim, here's where we're going to jump into our discussion today. And that is this asking kind of the overarching question of what is cryptocurrency? And so I know you are very well versed in this particular topic, but I'm going to phrase this question as if I were asking somebody in our audience. What comes to mind when you hear the word cryptocurrency, Jim?
So cryptocurrency, they are currencies issued by distributed payment network. Sorry, can't talk today. They're currencies distributed by digital payment networks. Uh, they do not have physical uh, representation. You cannot touch them. They're completely created, stored, and transferred over distributed computer networks. And so they're decentralized and they're independent of the traditional financial system.
So I'm going to ask a follow-up question to that, Jim, and I think this is maybe one that some people are kind of anticipating and looking forward to over the course of this discussion. But if there were particular topics in the area of cryptocurrency that you would hope that attendees to these webcasts would understand better by the end of these webcasts, what are some of the important considerations and things that people need to understand about cryptocurrency?
Yeah, so first, I think you would want to understand what they are, what purpose they serve. Do people use them as investments? Do people use them as payments? I would want you to understand how you can store them, how you can use them. I would like you to understand some of the benefits of cryptocurrencies versus maybe traditional currencies. Some of these we have on this slide right here, right? So they're stored electronically. You can hold them in what's called a cold wallet, which is stored offline, or a hot wallet, which is stored on an online exchange somewhere. They have near instant settlement. So if I send uh, cryptocurrencies to my made up grandmother in Peru. She can instantly get them. Unfortunately, my grandmother was neither from Peru nor is she alive. So um, they have low fees. Transaction fees are often a cent or a fraction of a cent. So they're very cheap and fast and they're accessible. The only thing you need to acquire cryptocurrencies is the internet. You don't need to go into a traditional financial institution, open an account. There's no KYC. And so one of the popular things about cryptocurrencies outside the US in more developing nations is it provided financial access to those who didn't necessarily have access to the financial system.
And I think that's an important consideration when you think about, as we think about all of the different kinds of financial transactions that go on in our lives, whether it's, retail transactions, whether we're, purchasing goods and services, and that is in payment for, say, for instance, a real estate contract, right? You pay your mortgage, for instance, or whether it is a payment between two financial entities. One of the reasons for cryptocurrencies to exist is to facilitate that process without some of the limitations of, if you want to think about it, physical cash or fiat cash, right?
Correct. Yeah, everything's instant. You don't need to worry about actual transferring physical bills. It's all very centralized and it all takes place on a permanent decentralized ledger. And so there's not this risk of kind of double transactions. There's one true history and new transactions are built on top of that. And so there's a couple types of digital currencies, and that's kind of what this slide talks about. And different cryptocurrencies have different use cases, but fundamentally, they're all decentralized digital assets. They're utilizing cryptography for security, right, to make sure these transactions have a degree of privacy, and they operate on blockchain. So Bitcoin is the largest cryptocurrency and the largest blockchain. Ethereum is the next largest blockchain. And so the thing about these blockchains is they're public. You can see anything that happens on them. So the individual transactions and those that hold the cryptocurrencies, they're stored through cryptographic keys. Stablecoins are different than something like Bitcoin or Ether. So Ether is the utility token of the Ethereum network. If you want to interact on that network, maybe if I want to send some Ethereum, some Ether to Ben, you have to pay a transaction fee. And so the transaction fees are paid for in the native token. If I want to use some sort of a lending application and there's a fee associated with that, I have to pay that with the native token. Stablecoins are designed to maintain a stable peg with an asset it's tied to. So most stable coins have a one-to-one peg with the US dollar. And so they're literally designed to be digital dollars. They're fully backed. There's rules in the US if you're a stablecoin issuer. The Genius Act was passed last year, and you have to invest in short-term treasuries. And so they're fully backed. When you deposit money into a stablecoin protocol, a new stablecoin is created. The money that you put in is always accessible. So there's not this aspect of many different institutions in the financial industry that when you put money in, that money is then lent out. So it's fully backed currency. And so that's one of the reasons people like stablecoins. You're putting, you have this digital representation of a dollar, and you know that the dollar is actually there behind it. And so the reason people like that beyond that is for the instant transaction side, stablecoins are not volatile. If I want to send Ben some money, Bitcoin can be up some days 5% in a day. I don't want to send Ben 5% more than I was supposed to send him. I want to send him exactly what I was supposed to send him. So stablecoins offer a stable value with all the benefits of a cryptocurrency in terms of transfer fees and instant settlement.
That's an interesting consideration because you mentioned this earlier in talking about those fees, and we see that kind of happening in the native dollar-driven space that we exist in for the most part now, right? So, for instance, you go to a restaurant, and I travel a lot, and so I see this all over the place, and it's becoming more and more common. You go to a restaurant and you pay with a credit card, for instance, and the restaurant charges an additional fee on top of that because they're passing on the fees of the transaction charges that the whole infrastructure of credit card processing has established and passes on to the restaurant. So it comes down to the consumer. But I think the intent then of getting to a digitally driven economy using cryptocurrencies is to help streamline and remove some of that friction, right, Jim?
Correct, exactly. The merchants that are charging these transaction fees, they're not doing it to because they want to. A lot of the times, if you're a small business, you've got
Right.
small margins, and a 2.5% transaction fee can be a major impact. And so for those types of institutions that really are trying to manage their costs and not put things off on their customers, that's the appeal of a crypto transaction from a business perspective is that you can eliminate a lot of these costs and still have the same functionality.
So I want to circle back to something that you just mentioned as we were talking about this slide before we move on to this next segment, and that is the fact that if an investor holds cryptocurrency, and we'll talk about some of the forms in which investors can do that, as opposed to making a deposit in your local credit union, for instance. You suggested that that cryptocurrency value that's deposited doesn't get rehypothecated to other loans. It doesn't get fractionalized. Whereas in the traditional banking system, you make your deposit. I'm going to go back to the Jimmy Stewart, "It's a Wonderful Life" analogy here. It's not the money's not in the bank; it's in your house, and it's in your house, and it's in your house. That's not necessarily a function of cryptocurrency, correct?
Correct. It's a completely different model. The business model of a bank is to gather customer deposits and then lend them out, right? So you pay your customers an interest rate on their deposits, and then you lend out your deposits. And ideally, if you're have a successful business, the interest that you're lending at is higher than the interest that you're paying at, and that's how banks make money. Stablecoins are not lending. It's just fully packed digital dollars. You're putting money in, it's now in a digital form. There's no lending on the back half of it.
I'm sure that at some point someone will try because that is one of the innovative natures of
Correct.
cryptocurrency is that it is addressing issues and addressing problems and trying to deal with some of the challenges that fiat currency and the traditional banking system has had. So I'm
Correct.
certainly there will be developments around that at some point, but that's not the core component of this, right?
Yeah, there are cryptocurrency applications today where you can deposit either volatile cryptocurrencies like Bitcoin or stable coins and earn interest off them and generate loans off them. And so there are things, but the stablecoin issuers specifically aren't. But there is the thought that could they at some point? Now they've said they won't, and who knows what happened, but at some point the U.S. banking system was fully backed too, and then then we went to 90% to 80%, and
Right.
today the reserve ratio at banks post COVID is actually zero. You don't have to hold anything in reserves, and so um, it's not a feature of the cryptocurrency world yet, but you never know. It could certainly happen. Maybe you'll get a some sort of issuer that says, well, we'll be 75% backed, and then we'll make a little
Sure.
more money. So, but as of now, it's still fully backed currency.
Interesting. Okay, so let's kind of circle back to what underlies all of this cryptocurrency discussion, and that is the idea of the blockchain. So let's talk a little bit more about this relationship between blockchain and crypto and start with this kind of premise, basic core premise. What is a blockchain, Jim?
So, a blockchain is quite literally a chain of blocks of transactions. And so what happens is when I send a transaction, I send a message to this blockchain every 10 minutes. And the message can say something like, okay, send this much money to this person or this merchant. Every 10 minutes, participants on the blockchain, the Bitcoin blockchain specifically called miners, they race to solve a math equation that generates an encrypted output. And if the miner, and this is a random output, so they're racing to do it, the first miner to produce the correct output is rewarded then blockchain. So they've now validated the latest block. They're chaining every single prior transaction that's ever happened. So that every single historic transaction is stored in this latest block. And so the blockchain is like I said before, you're quite literally chaining together historical transactions. And so the network always has this agreed upon correct and most current version, and you can look and it always verifies that the historical version is correct. And so this
So,
process is called mining, and it's
yeah.
designed to be secure, transparent, and accurate. There's no central authority that approves transactions. And so the way a public blockchain works is by not trusting anyone. If you have all these different miners competing against each other, they all want the block reward. So the block reward is several Bitcoin, right? So there's a nice monetary gain you can get from it. You also get a portion of the transaction fees, which can be anywhere from $200,000 to over $1 million per block you successfully mine. And so there's miners are looking out in their best interest. They want to secure the correct version of the blockchain, and they want to be the first ones to produce the correct output because then they make money. Because no one trusts each other, that's what makes a public permissionless blockchain work. Because I don't trust that Ben's going to do the right thing. I
Mhm.
don't trust that the next miner is going to do the right thing. But I know for a fact that if they do the wrong thing, they will get excluded from the network. So it's through this lack of trust that everyone keeps everyone honest. It's an innovative way to have something that doesn't have a central authority to approve what is right and what is wrong.
Now, we're going to talk a little bit more coming up here in just a minute about some of the risks, but that doesn't suggest that just because there's this mutual distrust that creates kind of an altruistic environment, that there isn't potential for bad actors or for other risks that might creep into the mix, right?
Correct. There's uh, bad actors can get involved, and so if you think about where could some security issues be, there are aspects of the blockchain that have historically resulted in issues. Now, the blockchain itself is incredibly difficult to hack. This is it's a math problem. If you want to change history in the block, if you just want to change the previous 6 blocks, you have to race to produce this output. You have to do it 6 times in a row, which is probabilistically low, and do it before the rest of the network just produces one block. And so the odds are not in your favor that not only are you going to be able to successfully produce 6 blocks in a row because it's a random output. The miners race to do as many of these outputs as fast as they can because it's just a random output that gets rewarded as the correct block. And so you have to assume however many blocks you're trying to change, you can do that before the rest of the network can just approve the next block. So as the network becomes larger, it becomes even more secure. Where hacking can happen is access points to the blockchain.
Right.
So wallets. This is an area of risk. If it's a wallet that's connected to an exchange, it's always on the internet. Someone could maybe crack your passcode. Someone could maybe crack your private key. Someone could maybe figure out your seed phrase somewhere. Seed phrase is kind of the backup access to your wallet. And so there's the risk there that um, someone from outside the network can access your cryptocurrencies.
The meme that's out there, I know, Jim, is the kid that comes home and his mom says to him, "Hey, I found this piece of paper on your desk with 7 random words on it. I just threw that away. You didn't need that, did you?" They're
Yes,
talking about that
exactly.
seed phrase, right?
So every single key, so an address or a wallet where you store your blockchain, a wallet can have several addresses in it, and each address has a private key that's associated with it. And if you think about it like this, a wallet is similar to, or rather, an address is similar to an email address. Anyone can send you an email, whether you want them to or not. What gives you access to your email is your password. And so your private key, when paired with your public key, which would be the equivalent of your email address, that gives you the ability to actually send out from there. And so that's the password. If you ever lose access to that, most wallets have a seed phrase for that address, and that's kind of your backup, almost like a two-factor authorization or a password reset that will allow you access to that address and the private key.
Okay, so as we start to talk about these risks, and we've gotten into some of those in terms of where hackers have a potential for entry or bad actors into those access points, there are a couple of other risks that are associated with this. We talked a little bit a couple of weeks ago about the risk simply of losing the password or losing your cold wallet if your cryptocurrency is stored in cold storage, and you happen to throw that USB thumb drive out, or you throw out your hard drive. A couple of very prominent newsworthy examples of that. But there are other risks, and there are even unknown risks at this point because this is still an emerging and developing technology, right, Jim?
Exactly. There's not clear regulations regarding a lot of what happens in cryptocurrencies, and so that could change. Now there's a bill being worked on in Congress called the Clarity Act, which is a market structure bill for cryptocurrency that would cement some perspectives that the SEC has put out in how they regulate cryptocurrencies today. But without anything actually being passed, a different administration, a different head of the SEC, they could revisit how they're currently viewed. And so that's a risk that the current regulatory views towards cryptocurrencies changes. Transactions are irreversible. If I mean to send Ben some cryptocurrency and I accidentally send it to someone else, I can't necessarily get it back. I don't necessarily know who I sent it to if I just put in the wrong address. And so
Right.
there's no one to reverse a transaction. If you think about storage, right? If you are storing cryptocurrency in a cold wallet off an exchange, this is essentially a USB hard drive. What if you lose it? What if it becomes you can't access it? What if one day you pass on, you leave your estate to your heirs, and they don't know about it? And so that there's kind of some unique risks to holding cryptocurrencies relative to other traditional assets.
Interesting. So, and again, as we get into these discussions over the next few weeks, once again, we're going to examine some of those risks a little bit more in depth as we get into more of the storage technology. And we're also going to talk a little bit as we get into the discussion of how do investors gain exposure to cryptocurrency, some of the risks that are associated with investing in cryptocurrency and cryptocurrency products. But as we move from this discussion of risks, now let's talk a little bit more about um, the role of, again, some of these very specific cryptocurrencies. You mentioned a couple of them before. We talked about Bitcoin, we talked about Ethereum, but there are others in this relationship, and these are just some of the types of cryptocurrencies, and kind of using that as a broad, overarching terminology, right?
Yep. So Bitcoin is the largest and original cryptocurrency. It was originally created as the native token within this payments network. Now, most people primarily hold Bitcoin as an investment and they think of it as a digital gold. And it's very different than gold. I want to make that clear. But some of the reasons that people say that is because it has a limited supply. So there's only 21 million Bitcoin that will ever exist. And every year, the amount of new Bitcoin that gets released into circulation, or sorry, every 4 years is reduced in half. But the similarity to gold is that in general, the new supply of gold released from gold reserves each year, it grows about, it's a 1% a year or so. And so Bitcoin has this pre-programmed releases. And so that's actually going to be about over the next 10 years, about 0.5%. And so it has a constrained supply where even if demand is stable over the long run, the new amount of Bitcoin can't meet that existing supply. And so that's why people think of it as a digital gold. Ethereum is a smart contract platform. And so this is the idea of programmable money. You can build applications on Ethereum or other smart contract blockchains. And what you need to interact with that blockchain, whether it's using an application or just as a money transfer, is to use Ether, its native token, as a transaction fee. And so it's a different use case. Now, some smart contract blockchains still have a disinflationary supply growth, and Ether is relatively disinflationary as well. But others may have more inflationary supply growth. And so something to think about. If some people hold it as an investment, as you should always understand, is this something that's going to outstanding supply is going to increase over time, remain relatively stable, or decrease? And then you have Tethers,
Yep.
USDT, and Circles USDC. These are stable coins, and so these are essentially digital dollars. These are often built on blockchains like Ethereum. And so a lot of the use case for them is again either payments or for use in different applications. So there's different crypto trading applications. Maybe you want to trade futures, something like that. And you would deposit stable coins as your margin collateral, and then you can trade in the various futures or offered on that platform. A lot of the time when you put fiat first onto a crypto exchange, they'll convert it automatically to a stable coin. Again, so there's this fast transaction speed between trading in between that and different crypto, more volatile cryptocurrencies. And so those are kind of the big four to be aware of, though.
So, two things I want to take out of this discussion specifically around this particular slide. One is one of the reasons for the existence of cryptocurrencies, not by any means the only reason, but one of the reasons is to provide some form of monetary mechanism that is immune from inflationary pressures, right? You can't just in the case, for instance, of Bitcoin, as you said, there is a finite supply, much like physical gold, but nobody can turn on the printing presses, for instance, and disinflate or dilute the supply of those Bitcoins, correct?
Correct, exactly. It's all pre-programmed, so there's not a way for the market to respond to the reduced supply. If you go back to commodities, what happens when
Mhm.
there's a commodity shortage? There's either an alternate good, people start using, more demand eventually comes online, or if eventually you get it's just too much demand outstripping supply, and then you get demand destruction. And so the only actual choice there is over time for a cryptocurrency, if supply is pre-programmed, the scarcity is a feature of these
Yes.
cryptocurrencies. So that's there's it's built into it, and that's part of the investment case. So that's the point. There's not an alternative. Investors like that aspect, and so the
Right.
only way that prices can respond to this supply is by first, finding a new market equilibrium, but eventually if prices get too overheated, you get demand destruction. And that's historically been the case for Bitcoin over its 17-year history. It's had its
Sure.
own unique cycle. There's typically been a period of excess interest trying to find that new equilibrium, and then ultimately things get a little too overheated and you have demand destruction.
And then you look at something like Ethereum, where there is not a finite limit to the number of tokens that are issued, but there are mechanisms that are programmed into the process to keep that inflationary pressure and dilution in check, correct?
Correct. So there is no way to destroy a cryptocurrency. Once a cryptocurrency has been created, it will forever exist. And so there's a mechanism called burning. And what burning is, it's just sending cryptocurrencies to a non-recoverable address. And so that's a way of taking money out of circulation. And what happens with every transaction in Ethereum, when there's a new ether that's created, there's also a portion that's burned. And that again, it works to try to maintain the overall supply of ether to make sure that it can increase when there's more demand for it, because think of it more like a growing network, right? You want to be able to issue some new currency so you can facilitate more economic activity. But again, you don't want to kind of dilute or inflate the value of the existing. And so there's a balance between the creation and the burning of Ethereum.
So there's one other aspect that I want to talk about relative to this slide, and that is the function of utilizing cryptocurrencies, whether it's Ether, or whether it's Bitcoin, or whether it's another form of cryptocurrency, as a means to transact business in the real world, right? So you and I have had this conversation about the fact that um, in some places there are Bitcoin, and I'll just use Bitcoin as the specific example because I know there are others, but there are Bitcoin ATM, automatic teller machines, sitting in a convenience store, for instance, where you could deposit cash, US dollars, and then accumulate Bitcoin. But one of the concerns and one of the questions that I think a lot of people that are brand new to the world of cryptocurrency is, well, how do I buy something with it? How do I transact, and buy a pizza with cryptocurrency, for instance?
So a great question. And there's a lot easier ways to purchase cryptocurrency than using an ATM, and cheaper ways as well. But typically, fintech companies have kind of acted as an intermediary here. So now maybe some businesses you can directly go to the person at the cashier, or the business owner, and maybe they have their own um, wallet set up where you can just send them the funds directly. But a lot of people, companies like PayPal, Block, and again, these are not recommendations, but Stripe, different fintech companies, they've now in their product offerings, a lot of their point of sale product offerings, they've integrated a way that if you want to pay with cryptocurrencies, right, you can initiate a transaction from your phone and it can take place, and settle through their system. And so again, it allows for that real world interaction where if you do want to use these as payments, you can work with the local merchant who will accept them because they have these different fintech products and point of sale products that have now been built to integrate cryptocurrencies.
And the reality of the world is that we live in, at least here in the United States, is that the goods and services that we purchase are priced in US dollars. So there's always kind of that intermediary relationship in terms of the value of Bitcoin versus US dollars, or quoted in US dollars, the value of Ethereum quoted in US dollars, and there is that relationship. But I suspect that at some point, and I think it's perhaps the goal of a decentralized finance, is that we'll get away from kind of that reserve relationship and things will be natively priced in those cryptocurrencies, correct?
Some of the biggest bulls like that's the thesis, right? That Bitcoin will become the reserve currency of the world. Um, I have a bit of a less bullish. I wouldn't say I'm bearish on Bitcoin or cryptocurrency certainly, but the broader financial system is probably has evolved to a pretty good place. Um, Companies are adopting blockchain technology. Um, And when you think about reserve currencies, actually the launch of stablecoins has actually resulted in more demand for dollars globally
Hmm,
than before. I mean, these are dollar-backed assets, and this is
right.
one of the biggest crypto assets. So in the short term, it probably more reinforces the dollar as the global reserve currency. But the core thesis of Bitcoin is really like this is you're holding this if in case everything else fails, right? If central banks
Sure.
are out, the global financial system fails. And this is an asset that was born out of the financial crisis. There was a huge crisis in confidence in the way the global financial system worked. And so the motivation was to create something that was resilient, that should the worst case happen, it won't be impacted. Now, to be clear, if there was a global calamity, cryptocurrencies are risk assets.
Sure.
And so I would suspect that they would certainly, be impacted to the downside. When in 2022, when the Fed was hiking rates, equities were in a bear market, crypto in a bear market. So they are influenced by other factors, other what's going on in the markets as well. But that is the
Mhm.
biggest Bitcoin bulls believe that one day the world will be priced in Bitcoin.
Well, I'll tell you what, I mean, Alexander Hamilton probably rolling over in his grave thinking about that particular aspect of this. But I will paraphrase what some people have said, and that is, we've got 250 years approximately of dollar-based infrastructure that has to be overcome to get to that scenario where something other than the dollar is the reserve currency, right?
Correct. And, it goes back to the point I made. Financial institutions around the world are looking to adopt this technology.
Sure.
Um, I, it's unlikely they're looking to adopt it to make themselves obsolete. It's right? It's technology. How can we improve what our business is doing? Um, the Bitcoin itself is a competing ecosystem for kind of the traditional financial industry. And so again, there's the biggest bulls. I don't like to be a rain cloud on this. I think Bitcoin would continue to be an attractive asset from an investment standpoint over the
Sure.
long term. Its adoption continues to grow. It does hedge against that, extreme, the most
Right.
extreme outcomes. But again, stable coins have really emerged as a leading way to facilitate transactions and a lot of and improve a lot of the inefficiency of the existing financial system without really tearing it to the ground.
Sure. So, Jim, while I transition over to the Thinkorswim platform, we'll take a look at a couple of the ways that investors can gain exposure to cryptocurrency, as well as review one of the example trades that we did a couple of weeks ago. I want to ask this question that was asked by Gretchen out in the chat, and it's an interesting one. Is AI going to make every individual a potential crypto miner? I'll let you answer that while I shift over to the Thinkorswim platform.
That's a good question. It's actually very difficult for individuals to mine Bitcoin today. It requires an exceptional amount of computing power. You would have to spend a lot of money. What people do who like to kind of mine on their own, there is that you still can technically just from your laptop mine Bitcoin, and you might get lucky and end up producing the right output, and that's kind of akin to winning the lottery in Bitcoin. But there's things called mining pools. And so what mining pools are is Bitcoin miners of all sizes. So individuals or big, publicly traded companies, they pledge their computing power and so that they can work together. They're individual, so they're looking out for themselves, but they realize by using their computing power, the likelihood of them receiving a block reward is higher. And so in those mining pools, you would get your proportional share. So still, if you're an individual miner, your proportional share of any block rewards is going to be smaller. But so AI wouldn't really increase your ability to mine Bitcoin successfully.
Interesting question. And I know there are other aspects of that regarding things like data centers and electricity use and energy consumption and things like that. So let's take a look really quick. I'm looking at a watch list here on the Thinkorswim platform. This is a watch list that we built at the beginning of the last series of these webcasts. And I've just got four symbols here that I wanted to look at really quickly. First, I've got /BTC, then /ETH. Now, those two are futures contracts. And that's one way that investors can gain exposure to Bitcoin as an investor. Now, we're going to look at those as measures of market movement, not necessarily talking about trading them. I do that on Tuesday mornings in my Trading Futures webcast. The other two symbols that I have on here are BTC/USD and ETH/USD. So that's Bitcoin and Ethereum priced in US dollars. And so that's a proxy essentially for what's referred to as spot cryptocurrency, the current spot price as opposed to the futures price. If you want to learn more about the futures relationship to spot, come and join me on Tuesday mornings for my Trading Futures webcast. But I wanted to look at these charts really quickly, starting with /BTC. And this is a 1-year daily chart. And you can see that the general trend of Bitcoin has been down somewhat. And you can see it priced again. This is also priced, these futures contracts are also priced in US dollars. If we were to look at Ethereum, and we can look at that chart of Ether, it looks very, very similar to the chart of Bitcoin. But if we look at the spot currencies, you're going to see that, or the spot crypto prices, you're going to see that those are, again, very, very similar to those futures contracts as well in terms of that price. So spot currency driving the futures. And then there are other aspects of how investors can gain exposure. And we built another watch list, Jim, when we did this, and that was our introduction to crypto in terms of some of the stocks that have exposure to cryptocurrency, either because that is their primary purpose is to hold crypto, or they're fintech stocks that have crypto as part of their business model. Yes?
Correct.
All right, so let's take a look at the one that we used a couple of weeks ago, and we actually placed a trade on PayPal in this particular discussion. We were right here at the beginning of June, and we were looking at PayPal making a breakout. And again, this is just simply from a technical analysis perspective. Again, not a recommendation or anything else. But the purple line that I've got here is the price of the Bitcoin futures. And PayPal holds a substantial amount of Bitcoin. They also have a fintech relationship, like we talked about with Bitcoin. So you can see it's mimicking that price fairly similarly. But in this particular scenario, PayPal, while it pulled back a little bit in relationship to Bitcoin, now seems to be moving in an opposite direction to Bitcoin at the moment. So if there is perhaps an arbitrage relationship there to be had, investors may find that. But at this particular point, we'll keep an eye on that and keep that a watch on that. Now, I want to address a couple of quick questions here, Jim, and then I'm going to throw one more question at you. JDML asks the question, are there any technical analysis or fundamentals that people can use to trade crypto? And some of these ways are looking at some of the fundamental relationships or fundamental aspects of these stocks that hold cryptocurrencies or have cryptocurrency dealings. Other than that, general technical analysis principles work with these products as they do with any other type of commodity futures or commodity stocks, those types of things. But the question that I wanted to ask you, and I think this is a really interesting one, and I will kind of wrap up on this particular question, and this is, in the technology world, technology quickly gets outdated. If we look over the horizon into the future, is there the possibility that another technology might come along and override Bitcoin or Ethereum or other cryptocurrencies, Jim?
That's a really good question. I love that. So the one thing I would say is there's always the fear of displacement. And right now I would make the case that cryptocurrencies are displacing other kind of more traditional assets. One of the things that has benefited Bitcoin throughout its history is another feature of different technology platforms. They're called network effects. So the concept of a network effect is essentially, first, the value of your network is based on the amount of people using your network. And there's different types of network effects you can get. But if you become this industry standard, it's very hard to break away from that. And the classic example of network effects was Facebook. Facebook was not the first social media company, but they became the leading company. And then it became very difficult to disrupt them, because how are you going to make a product that's going to compete with Facebook? Everyone's used to working with Facebook. And so when you think about cryptocurrencies, they've built this new product that's largely, and talking about Bitcoin specifically there, it's largely succeeded. It's gone from nothing to a $1.2 trillion asset. How are you going to introduce a new and competing asset that's better? People are already using from it. So one of the things
Mhm.
about network effects is it creates self-fulfilling value. And so it's very hard to kind of get people to use something else. There's a cryptocurrency very similar to Bitcoin. It has the same supply dynamics. It has the same proof of work consensus mechanism. It's called Zcash. The only thing that's different is there's more of a privacy function. Why has Zcash not been able to um, completely disrupt Bitcoin? If it's an improvement, you would think that. And then in this case, again, I would tie it back to network effects. Bitcoin is viewed as the industry standard. It's the leading cryptocurrency, and
Okay,
that's very hard to break. And so that is the risk over time, that technology can disrupt.
sure.
Um, but I would say right now, cryptocurrency is largely in the disruption phase. It's disrupting other technologies. But that's like certainly a risk that I would continue to watch for.
Awesome. Well, I'll tell you what, Jim, we always run out of time because this is such a diverse topic. We're going to talk more about how cryptocurrency works next week when we get to next Monday's discussion. Just a quick reminder, and thanks to Connie for calling this out. You can find more information in the recorded version of these webcasts on our Trader Talks channel on YouTube. Click on subscribe when you get there if you haven't done so already. My thanks, of course, to Jim Ferrioli, Director of Cryptocurrency Research and Trading at Charles Schwab. My thanks to Connie Hill for helping out. My thanks to all of you for joining us. We'll see you back here again next Monday morning. Have a great week, everybody. We'll see you soon. Bye bye.